Good afternoon, and welcome to our webinar on the property insurance crisis and beyond, how climate risk can affect municipal credit quality. My name is Triad Nguyen, I'm head of strategic data operations at DPC Data. And our goal today is really to engage in hopefully a lively discussion about rising climate risk in the municipal market and how such risk is starting to manifest itself through property insurance market disruptions in several states with potentially negative impact on governmental tax bases. We also touch upon the credit impact of state-backed insurers of last resort and on the outlook for climate risk disclosure requirements for our market. To do that, we're joined today by a panel of experts from different corners of the market. First, we're delighted to bring out of semi-retirement George Friedlander, policy and credit strategist for George Friedlander and Associates. George has been a fixture of Wall Street finance for 46 years, 41 of those as municipal market strategist at Citigroup. As head of research for the Municipal Bonds for America Coalition, he also worked actively on the implications of changes in the tax code for the tax-exempt market. And for 25 years, he functioned as market strategist for the executive committee of the PSA SIFMA. In 1990, he became the only research analyst ever to receive the PSA SIFMA Chairman's Contribution Award. Next, we have Dr. Jeremy Porter, head of climate implications research at First Street. As his job title suggests, Dr. Porter leads the research efforts focused on the implications of First Street's climate hazard models, particularly in the areas of real estate economics, population redistribution, and among many other topics. Jeremy came to First Street from academia, where he served as the founding executive officer and chair of the quantitative methods in the social sciences department at the CUNY Graduate Center. And he taught for over a decade at Columbia University's Environmental Health Sciences program. He holds a PhD in demography with PhD minors in applied statistics and geospatial technologies. From the institutional investor side, we have Derek Ansley, senior fixed income analyst at Loomis Sayers and Company. Derek has had over 12 years of experience in various roles in the municipal market. At Loomis Sayers, he primarily covers state general obligation and nonprofit healthcare issuers, with a particularly focus on larger states. Prior to Loomis Sayers, Derek worked at the PNC Financial Services Group. He is a member of the National Federation of Municipal Analysts and the Chicago Municipal Analyst Society. Last but certainly not least, from the public sector, we also welcome Megan Kilgore. As city auditor for the city of Columbus, Ohio, Megan oversees 7 departments tasked with the collection of income tax revenues, maintaining the city's $5 billion debt portfolio, carrying out all debt issuance investor relations, overseeing the city's $2.8 billion investment portfolio, managing citywide accounting and operations, including producing the ACFR and other financial reports, and providing payroll services for 10,000 employees. Wow, you didn't know the city auditor does all of that, did you? Well, at least in Ohio. Anyway, somehow Megan still finds the time to be an adjunct professor at the John Glenn College of Public Affairs at Ohio State University. And not surprisingly, she has been the recipient of many industry group awards. Most recently, the 2023 Northeast Women in Public Finance Frida Johnson Award and the Bond Buyers Rising Star Award. Finally, she recently testified in front of the U.S. Senate Committee of the Budget on the topic of municipal bonds and climate, which obviously brings us to the topic at hand. But first, I want to mention just a few housekeeping items. Next slide, please. Okay. If you have any questions for the panel, and we hope you will, please use the Q&A button at the bottom of your screen, and only use the chat box to let us know of any technical issues you may run into. The webinar is being recorded and the video link will be sent to all registrants. And of course, our standard disclaimer is that the opinions expressed are those of the speakers and do not necessarily represent the positions of their respective organizations and of DPC Data. For members of the media, we would appreciate it if you could obtain prior consent from the speaker for any direct quotes. We promise we'll get back to you as quickly as we can. So without further ado, let's get right into it. George, to kick things off, please frame the issue for us. I believe we broke all kinds of climate records in 2023. How has the municipal market responded so far?
Well, give me 1 second. Okay, here we go. State clearly, in my view, and in the view of a handful of major participants in the muni market, state and local governments are beginning to feel quite sharply the effects of climate change-induced weather events on their finances, credit trends, funding capacity, economic strength, and ability to support capital projects related to sustainability, resilience, and economic growth. However, and it's a big however, the municipal bond market and its participants have yet to show, in my view, even a glimmer of response to these changes in terms of trading patterns, relative credit strength, relative market value, and other factors that I'll talk about when I come back on a little later. In fact, I spoke to a major organization that represents the capital markets, and they're putting together a committee that is intended to help support efforts to finance the federal role in state and local projects. They are omitting climate change from their agenda because a substantial number of municipal market participants are strongly resisting its inclusion. In my view, we're really close to seeing the kind of changes in measurement of climate change, in confidence that climate change is truly happening, and so on, that will lead to a significant change in the way the municipal bond market functions. Give you just 2 examples, and then we'll get back to it later. The changes are happening so rapidly and not linearly. For example, we saw parts of California shift from deep drought conditions that induced massive forest fires and so on, to atmospheric rivers that are drenching the state. And then in Texas, we're still seeing ultra hot summers, but we're seeing icy cold and stormy winters. Both of these have capital implication and credit implication that we'll get back to later. These patterns and others in surrounding areas are generating major shifts for various regions, states, local governments, and microclimates. We'll talk about these some more when I come back on later. Now back to you, Triad.
Great. Yeah, you know, I mean, you and I have been around a long time in this market, and the municipal market doesn't have a great record in terms of, you know, discounting all these major changes, right? And we've seen it before. Okay, thank you, George. Jeremy, as recently as last week, Bloomberg recently called it a hidden U.S. housing crisis. And what they were talking about is property insurance rationing, for lack of a better word, by the leading P&C insurers is becoming the mechanism by which climate risk is starting to impact the tax base of municipal issuers. Mm-hmm. What are your current research efforts telling us about this growing risk.
Yeah, thanks for having me, Tree. I really think that this, it really falls under the umbrella of this unknown risk metric that George sort of alluded to this. There's these transitions in risk, but there's really a misunderstanding of the impact that climate risk is having on the real estate market and other sectors in society, but also the speed at which it's happening. And lots of times, when we first started doing our research, we would hear, I believe the climate change is going to impact the real estate market, but I won't be around in 2100. As you start to look at the research now, you're seeing not only is it going to be 2100, but it's been happening in the observable record for the last 20, 30 years. We're already seeing signals in the transaction record, for instance, in the real estate market. We're starting to see areas that are exposed to more climate risk see lack of appreciation if it's not just negative property value decline. So we're seeing this in different types of ways, but in that same vein of kind of hidden climate risk, some of those risks aren't what we're sort of accustomed to understanding. So it's not necessarily the 1 in 100 or the 1 in 500 year storm that is really impacting the housing market in a way that we oftentimes think of these economic shocks coming in and impacting, local cities and local communities. Instead, what we're seeing is that there's this persistent stressor of sort of chronic flooding that's occurring from more frequent, less impactful nuisance title flooding or 5-year precipitation events that are flooding people's properties. And we're starting to see that make its way now also into the insurance market. So the transition from focusing on the wrong types of metrics, not focusing on the chronic metrics, but only focusing on the rare events, and then starting to think about the ways in which we've kind of built climate debt up over time. I mean, we haven't really adjusted a lot of our practices in the insurance market, and this goes all the way back to the way you think of, if you think about, for instance, the federal government's NFIP program. When it was instituted in 1970, it really didn't have any type of significant upgrade until the last couple of years when Risk Rating 2.0 was implemented. That adjustment was really taking climate into account. We're seeing that also in the private market. We're seeing it in the reinsurance market. And as that's happening and we're starting to take into account this hidden risk that's starting to become uncovered, it's making its way into the market and starting to impact that climate debt that's built up. And really the first way we're seeing climate be priced into the real estate market is through increasing insurance premiums. And so we've been looking at this through our own research. We've actually found that there's about 7 million properties across the country that have already been pushed to insurers of last resort across various states, places where they're already having trouble finding home insurance or wind insurance or flood insurance in the NFIP case. And there are another 30 million properties across the country, about a quarter of all properties, that have risk profiles relative to one of those climate perils that's equal or worse to the risk profile of properties that are already being pushed to these insurers of last resort. So there's this dramatic amount of risk. There's overvaluation that exists out in the property value market, and we're not actually taking it into account holistically yet. We're starting to see the insurance market and the insurance industry do that a little bit, but it hasn't been fully priced into the market. And on top of that, we're starting to see people respond to these increasing housing costs. So our recent research around climate migration actually found that there's about 800,000 U.S. census blocks across the country that saw decreasing populations from 2000 to 2020, with a portion of that directly attributed to flood risk in the models. And it sort of flips the narrative on its head. We've seen nationally that people are moving to risk. They're moving to Florida. They're moving to Texas. They're moving to California. But that's only about 15% of all residential migration each year. Most residential migration happens within communities, within cities, within MSAs, and people in those areas have local knowledge. They know, what the cities look like. They know what streets flood when there's a heavy precipitation event. They know which area has basements that flood, and they're taking that information and they're moving and they're avoiding those areas, even if subconsciously. So we're seeing sort of this culmination of a lot of different research focused really on the micro scale, at the property level, at the city level, at the neighborhood level. And we're starting to see these little indicators that people are responding to climate. They're taking climate into account when they're making these important decisions in their own lives around real estate. And I'll pass it off to you, Tree, but I'm happy to answer more questions about that.
Yeah, I have to mention for those of you who are not aware of First Data's products, I think in a way, through your risk factor product, which actually allows people to actually put in their own address and get the risk profile on their own homes, so to speak. You actually really driving it home, literally, right? And that almost can become a self-fulfilling mechanism when people start to look at this data before they make a purchase or sell a house. So that I think I find that very fascinating. Thank you so much, Jeremy.
Sure.
Derek, how are you and your colleagues at Loomis Sales taking climate risk into account in your current credit research and risk management practices? What tools do you find useful?
Thanks, Triet. Yeah, it's a pleasure to be here today representing Loomis. As an institutional investor, we've taken the approach that in serving our role as a fiduciary for our clients, the best way to consider climate risk is to assess its financial materiality. More broadly, the same can be said for social and governance risks. Very similar, we view this climate risk as a secular trend that will continue to accelerate in the medium term. Our financial materiality cornerstone really focuses on 4 key facets, those being customer focus, credit research, valuation, and issuer engagement. Within credit research, we utilize external data sources as well as our own proprietary tools when formulating our opinions of that financial materiality. Earlier, you heard both George and Jeremy describe really the market's indifference to climate risk currently from a valuation perspective. Our view is that misunderstanding of risk is really an opportunity for our clients, given that our longer term hypothesis supports the market incorporating those risks into valuations as we move forward. I will say that issuer engagement is a bit of a challenge in the municipal space, particularly for smaller issuers. That's not in any way shocking to most of us on the call here, but it does limit, in a sense, our ability to assess any mitigation efforts that the issuer has placed or is planning for. Treat also asked me to give a sense of what our clients' concerns and interest level is. I think some of the themes that we hear most often are an acknowledgement that really ESG is here to stay and therefore has to be considered. But almost before they get that thought out of their out of their head, the next question is, what will that mean for risk and returns? So we're in our credit research, similar themes to what Jeremy and George had described. We're taking both a top-up and a top-down view in our selection, and the opportunities for valuation to change over time are really where we're focusing. When that gets incorporated is kind of the $64,000 question, but it will come, and we want to be prepared for it when it does.
Yeah, that makes perfect sense, Derek. I mean, you guys, when most of the market participants are just adopting a wait and see approach, you guys view it as an opportunity to improve the risk profile of your client portfolios without much, giving up much yield, if any, at this point, right? So that really makes a lot of sense. Speaking of issuer engagement, Megan, you have the distinction of serving the largest city in America with a AAA rating from both S&P, Moody's, and Fitch, I believe. Columbus is also a disclosure star. One of the fastest, largest city to issue its annual report. While Ohio is certainly not an extreme case, like Florida or California, I'm sure the state does have its own climate challenges. So now, how are you and your colleagues in Columbus getting a handle on your climate change exposure?
I appreciate the question, appreciate the time. Indeed, Columbus is the 14th largest city in the nation and rapidly growing. And I think, you know, my motivation, if you will, we have a deep bench of resources here, internally and externally. But the ideas around climate adaptation, mitigation, it's inherently really complex. So my motivation is really to further the conversation and help governments work through this complex reality. The angles that I think I'm most focused on right now, really one is to find ways to harden more infrastructure and perform more climate-oriented projects. And with that, you know, what kinds of topics should we be looking at in terms of ROI? What kinds of projects are best suited for that particular area? And how to sleuth through the channels and channels of available funding and all very disparate streams. The impacts of insurance is what's been really driving my conversation lately. And I think, Trina, it's a really pretty simple formula. We know as local government officials, we know that the consequences of climate change are increasing things like insurance claims and payments. We know the frequency of major climate-related events is also growing. So that means more cost to our consumers. But to further kind of complicate this, some private insurers, as my colleagues on the panel have already showcased, some have gotten out of the business, which is why we've seen growth in, you know, state-created residual insurance plans. And to me, that shifts the burden of responsibility further to the residents of that particular state, to our taxpayers, either through taxes or state borrowing. So it comes back to who is ultimately paying for the consequences of climate change. There was a really awesome article in Bloomberg, it's probably 2 weeks ago now. The title of it is A Hidden Crisis in US Housing. And I want to share a quote from the authors because I think they did a really spectacular job of explaining the role that insurance plays in the US. And it's really appropriate for anyone who's in shoes like mine as a elected official to kind of conceptualize it this way. And the author's right. It's hard to overstate the role that insurance plays in the American economy. Banks won't make mortgage loans for uninsurable properties. Without these loans, the real estate market slows to a crawl, which in turn eats away household wealth and the tax revenue that state and local governments rely on. So I think that quote, it perfectly sums up why folks like me, even outside of disaster-prone areas, as you acknowledged, are becoming increasingly aware and responsible of the risk and the opportunities that are ahead.
Yeah, thank you, Megan. You know, as I have to say, as a credit geek that I am, I was very happy to see when I was going through some of the recent official statements on some of the videos that you actually have climate change right in the security section of the official statement and not buried in the back somewhere, you know, in on page 35. So I think that's that shows. I think that to us, I mean, and all the other analysts out there, that shows that you do take it seriously, and you guys are dealing with it.
You know, I think that's a period of evolution now, and local governments are certainly not one size fits all, and neither is the quantification or how we really report climate risk. It's really hard. But as a debt issuer, you know, we do seek standardization and simplification to make sure that we're doing it accurately, correctly, et cetera. So I really, really appreciate the work that the GFOA has done in providing recommendations and best practices. That's who really advised us on our levels of disclosure. It helped us also kind of navigate some confusions as we seek the best ways to, I think, responsibly and realistically forecast risk as well. And showcase, for example, our philosophical belief that the capital plan and our climate plan are actually connected. They're not disparate. They're very much connected. Just from a time sensitivity, I noted last week, and I read the chair, SEC Chair Gensler's remarks, the disclosure rules on the public companies and public offerings are out. And I think it's fair to start at least asking what could be transferred over to the muni markets. And we certainly will be doing our role in digging into this.
I mean, since we're on the topic, but do you think climate risk disclosure is coming for our market? And
I-
what would you
Sure.
expect that to look like?
I don't think we could have as much communication and quantification as we are having without it being a very, very relevant topic. And as to what I think it's going to look like, I don't have any insight into that. But I know we will be looking to our partners at GFOA and others for help in navigating that so that we do it as best as we can.
Yeah, I think, it's probably optimal for us as a market to be proactive about it and perhaps start to come up with an industry-wide best practices, right, for disclosure as opposed to waiting for regulation to be crammed down our throat, right? And I'm hoping that the industry is coalesce around some type of standard disclosure and on a preemptive basis, and that will be the better scenario. And it would seem that you want to pair, some recognition of the risk, and then match it up with what are we doing about those risks. And I think that combination is really, at least in my opinion, what the market should be looking for. What do you think about that, Derek?
I mean, we like, obviously we want as much standardization as we can get from our issuers, just from a, trying to keep apples to apples comparison amongst issuers. It's probably not a realistic goal in the next couple of years, given the lack of guidance that issuers receive. I will say that there are some of the larger issuers who have married their capital plans with their climate outlooks, tend to be more positively viewed in the institutional space. But you're going to see disclosure kind of across the gambit of very robust to non-existent.
Yeah. How about you, George? But any thoughts on the subject?
Yeah, I'm, for the most part, near term, a pessimist in terms of how the muni market handles these changes. I think over time, with more evidence coming out of weather-related events, the market is going to have to take into account these changes in relative valuation that I'll talk about in a minute. It's important to stress, I think, that climate change is highly capital intensive. This means lots more potential projects that will need to get funded somehow to deal with sustainability, resilience, modernization, and protection from weather change. But I question how state and local governments are going to be able to pay for this unless there's a lot of banging on the drum to get federal governments to take this much more seriously than they have so far. And I appreciate a lot that Megan is so close to this and is testifying on these kind of issues, because this is could be a part of the major challenge, especially near term. The volatility we see, the state local sector is highly vulnerable to changes in federal politics that place risk on sources of financial support and funding support for climate related projects, and especially to changes that have to do with migration that several of the other speakers have already talked about. We're going to see, I suspect, pretty intense migration away from parts of the country that have the worst weather-related events, floods, fire, being near the ocean, and so on. this is going to lead to more migration. It also is happening, and I'd love Megan's comments on this. In an environment of housing crisis, if more and more people are moving away from these areas of weather concern, where are they going to, especially in an environment where insurers are highly averse to creating new pools of insurance in areas that are related to this. Given the role of increasing temperatures that we're seeing, the form of weather disasters will continue to be of high magnitude and high variability. And the muni market is, as several of my colleagues have noted already, is just not taking this all that seriously. It's also showing up, I fear, in the too short nature of credit analysis. I don't know how rating agencies are going to be able to measure future changes in credit strength rather than, gee, issuer ABC has lots of financing pools available now. Those will change quickly, I suspect, but the rating agency component to that have just not taken it up yet. So we need to see how the rating agencies adapt to this over a relatively short period of time. And lastly, on all of those factors, there's a major growing role of client science in credit analysis, where these events need to be measured, but they also need to be measured in relatively micro components of the muni market. We can't just say that New York State is going to have more weather events. We need to know what those are in a relatively small component of New York State that only client scientists will be able to measure. Just on the good news, bad news side of all of this, now we're going to, I believe, see wider credit spreads. We're going to see a steeper muni yield curve. We'll see muni yields as a percentage of treasuries increase, especially on the long end of the curve. On the good news side, I think a well-articulated understanding of the growing credit pressures stemming from climate change should lead to expanded federal policy components that support state and local governments as climate change leads to growing credit risk and growing funding needs. Secondly, the muni market, as we've all said, to date hasn't taken all of this all that seriously in terms of valuation. I think that's going to change really fast. I think over the next 2 years or so, we're going to see a muni market that takes climate change much more seriously. And that means changes in relative valuation in a number of ways that I've already talked about. Steeper credit spreads, wider credit spreads, steeper credit curves, wider credit spreads, and challenges in getting the funding that is needed to pay for climate-related projects. And the only way that can happen, in my view, is if the federal government takes all of this much more seriously than certainly the right has so far. But it's not just a problem on the right, it's a problem in how projects are funded in an environment of really skittish, a really skittish sense regarding the amount of funding that the federal government is willing to do and how it's willing to do it, the strategy the federal government is going to use to pay for all this. I would love to hear Megan's response on any of this in terms of how the federal government is responding to. So
Well, George, there's so many good thoughts in that. Your encyclopedic knowledge. It's always inspiring, but like, let's be honest. I met you, George, just in the last couple of years, but you have been talking about this for some time. And I think that's what's really interesting is like, and this is the crux of kind of our topic today is, I think with local governments and our even more broader public finance, our traditional tendencies, it's often to like judge risk by looking backwards and in arrears and thinking, well, this area hasn't experienced, my area hasn't experienced extreme weather event, and just kind of accepting that that's probably low risk. But with climate and the fact that you have all of these direct and indirect consequences, that mentality simply doesn't fly today. And incrementally, here in Columbus, we are experiencing, feeling, and certainly seeing the cost today of climate change. And what's interesting, and along like with my colleagues across the country, I have had a lot more conversation with them around how to better inform our own models with predictive data, how we can better harden our capital plans, and certainly, keep affordability in check. But for those local governments who are driven by property tax bases, that's also a totally different conversation. It's also understanding how the changes to things that are inherently in your head more private sector, but changes to things like property insurance could actually impact municipal bonds. And I think that we've got a lot of great work ahead. It is not being driven. I feel like change is often driven sometimes by the Fed, sometimes by rating agencies, because you're required to kind of go through the marching, process and learn and really, investigate. But I would say there's kind of like, really, it's the conversation that's being held nationally that is driving more awareness for folks like myself. And I got to give us some credit to people who I think are doing a good job of reaching local governments. And the one in Treat, you kindly referenced this, Senator Sheldon Whitehouse. He's the chair of the Senate Budget Committee, and Tom Doe. Tom's the founder and president of Municipal Market Analytics. Both have a really interesting way of breaking down these like hyper microeconomic trends to frankly very local levels, and to explain how things that might feel very far away, both in terms of like geographical presence, like a California to an Ohio, but also in terms of time, but really have very serious implications for the present. And I think that because of that conversation, it's trickled its way into things like really good journalism. And I see some of the questions that have been already tossed over into the chat. I went down a rabbit hole with, I think Liz Sweeney, incredible Liz Sweeney, asked a great question about data around like insurance and things like that. I personally went down a rabbit hole after reading the Bloomberg article because it opened up my awareness to some data sources I had never heard before. And I just became a lot more interested and knowledgeable for that. But honestly, Jeremy, you do this in a really cool way. Do you mind chiming in with your thoughts?
Yeah, I mean, I really want to echo your point around awareness. I mean, we've seen a huge increase in this types of climate analytics data that's come out in the last, decade or so, and it's not a coincidence that at the same time we're seeing more organizations and industries use these climate analytic tools in their own work, but also that we're seeing the emergence of the SEC rules that have come out. I mean, these things are all happening at the same time. To some degree, they're happening because we're seeing the increased frequency and severity of climate events, but we're also understanding to a much larger degree the impact of these events at a hyper-local level. I really like the point that George made around, these are sometimes thought of as kind of abstract climate science. I mean, obviously your everyday person, they're not quite sure what that is. But if you can localize it, you can make it meaningful to their property. You can make it meaningful to their neighborhood. All of a sudden, people in Columbus, Ohio, can say, you know what, we can actually see that extreme precipitation events are increasing by 20% over the last 30 years. And what used to be a 1 in 100-year rainfall event is now a 1 in 30-year rainfall event. Is our infrastructure built properly to account for this increase in extreme precipitation events. So not that that's the case there, but we are seeing these types of ways in which people are using this data, and a lot of it is driven by awareness, and it's driven by our own data, which we integrate into Realtor.com and Redfin.com. That's really on the consumer side, but people are going on, and for the first time, they're fully informed around climate risk when they make decisions around the home buying process, and that hasn't happened in the past. So as people are becoming more aware, as particularly smaller municipalities are starting to have access to this kind of data in the ways that they haven't had funding to do engineering studies and to do resilience studies in the past, we're starting to see climate risk analytics permeate really the entire ecosystem. It's sort of making its way through the ways in which people think about climate risk, not because it's just happening, but because people are becoming more aware around it. I think that's really where we feel like our organization at First Street fits into the pipeline, is creating these hyper-local, rigorous scientific models where we localize the risk. And we have a flood model, wildfire model, a wind model, a heat model, and now an air quality model. And you can go on and people can see what's my climate risk at my location. And if it doesn't affect me, does it affect my community?
Yeah, I think by, just by making that data available to the individuals, I think you are at the risk of becoming the agent of change yourself, at First Street.
There's been some really, I'll just 1 second, there's been some really interesting research that shows that if you show people the climate risk data, they systematically search for less risky homes. So people are taking the information in, but there's that necessary condition of having to be exposed first.
Right. Plus, they can get, anybody to write the home insurance policy that also drives it home, right? Just to get back to Liz Sweeney's question, obviously as a data vendor, that is kind of the hot and burning question that we're trying to chase down, any indicator of property insurance pricing at the local level. That is not, it could be a challenge there for Jeremy and his group to try to come up with something there. But I think we're looking for it. And I think there's even part of the PPI index. I think there is a insurance component to that. But it's as far as we know, it's not available at the local level yet. And we need that kind of data. So that's great. Now, I guess we, given all the issues that we talked about, I guess we can always leave it to the politicians, and President Company accepted, to distort the risk pricing mechanism, right? That's built into the insurance market. Derek, what do you think about certain states being forced to become insurers of last resort? And of course, we're thinking about Florida's Citizens Property Insurance Corp or California's FAIR program. Do you think that will have an impact eventually on state credits?
It definitely has the potential to. In the instance of Florida, those bonds are secured by a special assessment, which is levied on the policyholders. So Megan was touching on how do you balance that burden between residents and the state. Positively, it provides some stability to the market, which is a good thing. It does promote a more competitive landscape for the insurers. So if you just kind of hold everything else equal, that backstop does allow private companies to come in and offer policies, which are obviously positive. The elephant in the room is affordability for residents. It's a pressure, and given kind of the localized nature of these extreme weather events, the premiums are substantial, and affordability is something that I know just nationally there's increased focus on affordable housing. It's a pressure for people when they're making decisions as to where to live. In the instance of Florida, it's worked well. They've only issued 2 bonds in the last 50 years, but they're large, debt issuances. that are essentially forced onto the property owner. How that translates over time, a lot of it will play out as weather events happen. We are so early in the process of trying to figure out how this is going to impact state credit. I will say that there was another question in the chat about what the public rating agencies are doing. In my opinion, Moody's has the most robust methodology for assessing climate risk. They're dealing with some of the same challenges we've talked about. They're trying to get their data into the most localized level, given the fragmentation in the market. It's very easy to think, oh, California has this risk, Colorado has this risk. A lot of the burden is placed on the local municipality. Megan can can speak to that better than I, but these micro areas that are susceptible to extreme weather events, the resiliency that they have, it's all about their planning. At the end of the day, it's how well are they planning in the event that something happens. The more robust their planning and the more financial flexibility they have, the better. I will state that it's interesting that some of these climate issues have rose to the forefront in a period of very, very low supply. That has kept spreads very, very tight in the municipal space. Deals are anywhere from 8 to 20 times oversubscribed. There is very, very robust demand, and we're in a period where there just has not been a lot of issuance. So again, it's an opportunity for investors, but it's in a historically unusual time from a supply standpoint.
Yeah, I think that you're suggesting that actually the technicals of our market has kind of served to obscure the real impact, the real credit impact of climate risk so far. You know, because
let me make one point on that.
Yeah.
That is really, really important in my view. We've had, as Derek notes, this really compact supply. We're also moving, though, into an environment where the individual investor and separately managed accounts representing the individual investor are virtually the entire demand in the market. Bank demand is sharply net negative. Property and casualty demand, which used to be the long end of the market almost exclusively, is B&Cs are kind of flat, but individual investors are only beginning to get a handle on the kind of factors we're talking about. As they become more acclimated to these potential risks, that's going to affect relative values as well. We need the market to take relative values and risks and relative values related to them much more seriously. And I think that's going to come, especially as individual investors become so dominant as a source of demand. One other point on that, one of the major players on this has suggested we're going to see a lot more supply because of climate change. I strongly disagree with that. I don't see that state and local governments are going to have the revenue sources necessary to do the things that are needed on sustainability, resilience, protection from specific weather events, and so on. The federal government's going to have to get a lot more involved, and we're going to, as an industry, going to have to get them more involved, or the dangers on credit risk will just continue to increase.
I want to answer or respond, George. You brought up something that I think is worth really addressing, especially with all of these attendees. And it kind of answers Sarah, your very good question. Like collectively, this whole panel, we could list all of the factors pertinent to climate that should be acknowledged when assessing, I'll say, rational and frankly very like quantitative risk. But there's this gargantuan additional factor that I think is not only kind of very qualitative, but quite subjective, and that is management. Meaning you can have a very at-risk geographical location, but if they are with management smart enough to proactively plan for the future, to go after, and it's complex. We're struggling with just the reason I said really yes to testifying at the Senate was to be able to help reduce the complexity around these different federal programs. They're robust. There's never been more available to us, but they're happening at a time when not only are there individual rules so specific, but we have a staffing crisis in local governments across the nation, right? So, George, I think what separates good from great in terms of credit quality, even in places that are high risk, what is the management doing about it to mitigate, to proactively plan? Because it might really absolve them of some of the material things that as an investor, I would personally care about.
Let me just respond to that very, very quickly in terms of my concern, in terms of management. Management in many cases means at the gubernatorial and legislative level. And there are a lot of states that do that very, very poorly. And I question how they're going to be able to respond unless some very loud drums are banged on them and they become much more aware of how these changes are going to affect their ability to function. Right now, in many states, it's not very good.
I agree with you. Like from an economic development standpoint, if I'm an investor looking across the country, I'm going to be looking at the communities that are thoughtfully trying to create the city or the state or the county they want to be in 10 years by leaning in on things like recycled wastewater, like some really incredible technologies to position. And to your very, very good point, George, just because managerially local government might be trying to do the right thing, they might be quite at odds with their state legislature or their governor. And therefore it makes it really hard for them to be successful. But I think that's why it's so hard. And Derek, you hit on this, to seek appropriate categorization of risk in any type of standard way, because it's so nuanced.
And just one last quick point on all this. Universities are going to have to play a really important role in all sorts of ways of researching all of this and designing new parameters for dealing with it. I take, for example, University of Oregon that does wonderful work on urban design. Well, urban design overlaps tremendously with what's going on the climate change side. And partnerships between universities and what you call management at the state and local level is going to have to get incredibly more nuanced than it has been historically.
So, but I think what we're saying is, on one hand, we want to find a way to quantify the risk side of the equation, but we also want to find a way to quantify the mitigation efforts and the governance piece of this, the government piece. And that I want to address one of the questions there that we haven't touched upon. What price guidance have you used to consider climate risk? Yeah, is it possible floods? So the bond should be priced 25 basis points wider, so on and so forth. That is obviously the question for the market itself to answer and find its level. I think the first step really is as Derek mentioned, is somehow coalesce around some kind of standard approach to measuring this risk. in some way, shape, or form. Then over time, I think people will prefer bonds with a lower risk profile over one with a higher risk profile, and the pricing will fall out of that. I think the market will find, it's at an equilibrium, but
Yeah,
it's
well, Tria,
there's no way that we can say it's worth 25 basis points right now, or 10 or 100. And I assume that also, the lower rated issuer will probably incur a higher penalty just because of that they don't have quite the same amount of resources to address the issues.
Tria, just one point on that. My expectation is that the high yield muni market is going to take it in the neck in terms of widening out significantly, because weather events are going to cause a significant amount of additional issuers to become below investment grade. And I include in that category universities and hospitals in particular, that where major weather events that affect local conditions will be extremely damaging to credit. And that's going to push more issuers into that high yield category. And I don't think it's going to take long for us to get there.
Yeah, and there's a plethora of issuers or deals in our market which are really secured by very narrowly based, geographically based, revenues.
Yeah.
The development districts, which Megan has worked on before, dedicated revenue bonds. Those are all very vulnerable to localized climate events, and I think eventually you wouldn't want to buy a development district without knowing what its kind of risk profile is. It just doesn't make sense.
Can I just add one thing?
Please.
There's a lot of discussion around standardization, which is really important to understand how to standardize, but the complexity associated with the issue means that we can't, to Megan's point, we can't lose the nuance and the complexity when we're standardizing. So whether it's a big city on the coast or a smaller municipality in the middle of the country, we need to be able to tell the same stories to individuals with the same data sources so that they can make decisions appropriate for their communities in terms of adaptation, mitigation, and looking forward. And we haven't done that and taken the forward-facing approach in a standardized way that includes the complexity up to this point.
Great. Well, I think we're coming up on our time now. Let's see if we have one. We can take one more. Do you think there is an opportunity for community-based insurance programs? If so, who might lead them? Maybe Jeremy, you have
Say
any
that
thoughts
again
on-
louder. I couldn't hear you.
Do you think there is an opportunity for community-based insurance programs? And if so, who might lead them? I mean, I think, the current property insurance crisis is really, I think leading people to think about, different type of insurance models now, right? And I think all of that is still evolving as we speak. I mean, that certainly is where I don't know, none of us as insurance experts, but I definitely think that there's different models that are being pursued right now that would be more flexible than just relying on the P&C companies to be the risk transfer mechanism. And let me see. Oh, this is what I particularly like. I think Megan and I would probably enjoy this. Do you think there's a reversal of the population inflows to Florida and Texas? And does the upper Midwest, for example, stand to benefit? I think so. We had 70 degrees here in Chicago in February. That could be the beginning of the trend, right, Megan?
I think that we have to acknowledge too that if we look at where the incentivization has already occurred, meaning lower state tax, income tax rates to get people to move there. We have to acknowledge that, interestingly, they happen to be states that have the largest climate risk. And so very much like core to my desires right now, the power of the municipal markets. We can incentivize using some ability to get mini bonds out there to actually put that power back in the hands of local governments and use those investors who are so motivated by, the avoidance of taxes, to get them to also invest and move the capital to the places that really need it and invest in the projects that'll make our communities better and stronger.
Well, that is a great message to end on. And this has been a fascinating conversation. And I'd like to thank all our panelists for their wisdom and insights. In closing, I should mention that we're working with First Street to make their data available on the DPC platform. So alongside other vendors, such as Spatial Risk Systems. So thank you again for your time, and so long.